All right, so once again, sorry, let's continue with the game. Now, we mentioned that there are three things you must know under the basic earnings per share. So basic earnings per share, there are three things. And we've done two. Left the third one. Number one is issue of shares at full market price. The next one is the bonus issue, in which we look at it. The last one we are going to look out for under the basic earnings per share is what you call right issue. And please don't go anywhere. Make sure that your internet is strong and good. Because if you miss right issue, you have missed, in fact, if you miss the rest of the story, you have actually missed earnings per share. The number 4 is called diluted earnings per share. I'll come and write another thing here. This is number 4. It also have 3 issues, A, B, and C. I'll come and write them down. So earnings per share, you must know this. If you understand this table, you should be fine. And we'll move on. What is the comparative earnings per share for 2020 from the question we started solving? Okay, so I think we finished and we had a particular answer. I think I've lost my whiteboard due to the fluctuation in the connection. So please, you can go back to the previous video or those who have it. Yes, we had 0.47. No, we had 0.38. And it's only for it's only for 2019, please. We don't have 2020. You see, in 2019, this is how it's supposed to be, 2020. We calculate the basic earnings per share. So earnings per share, the normal one. And we said that you cannot compare the normal one here because there's some bonus element here. Here, there's no bonus. So here we cannot compare. Then why can't you calculate another one in 2019 alone, which will now feature in bonus? So 2019 bonus coming, then now we can compare it to this. So that's what we did. So there will not be any comparative for 2020. It's only for 2019. Just that it will be calculated in 2020. What a good news. It will be calculated in 2020, but calculated for 2019. What a wow. So we are done. Right issue. Right issue. Right issue. What is the right issue? All those who are doing FM, financial management, please take notice. It's also due for examination in financial management. Right issue. It's also due in exams. So this semester we have to start early. So right issue, what is the right issue? I left with only 2 things and I'm done. Right issue and diluted earnings per share. Please don't go. Right issue. When you say right issue, what's the meaning? Somebody will say shares issued at the right side of the entity, right? No. Right issues are shares issued to existing shareholders below the prevailing market price. That's all. Take notice. Shares issued at below the prevailing market price. So shares issued below, take notice. Shares issued below the prevailing market price. per share. Per share. Usually to existing shareholders. Usually we can say that usually at a discount. At a discount. The shares were issued at a discount. So take note, discounted shares. So let's assume that the prevailing market price is, let's say, $3. $3. If we are given a discount of 10%, what will be the right issue price? You can tell us. So a discount of 10% will produce a right issue price of a discount of 10% will produce a right issue price of what will be the right issue price? Can tell me. Yes, 27. Good. I think that. So just take 90% of that $3, or just find 10% and subtract. So you get $2.7. So long as usually the shares below $3, it's a right issue. Simple as that. Let me tell you the short story. All what I've said is not important than what I'm coming to tell you right now. You see, all what I've said is not important than what I'm going to tell you right now. What I'm going to tell you right now is what you must know. Right issue have two features. It has two properties. So there are two properties of right issue. So characteristics of right issue. Characteristics. Know them. Let me call it RI for short, okay? The first one, it has a characteristic of what? Issue of shares at full market price. So some of the shares were issued. So some of the shares were issued at full market price. At full market price. Okay. Will you continue? Please. If you see shares at the full market price, what's coming to mind? You can remember us. Please. You've done it too. Anytime they issue shares at the full market price, what should come in mind? Anytime you issue shares at the full market, what come in mind? What come in mind? Anytime you issue shares at the full market price, first thing that come in mind is what? Wait the average. So we must weight the average. So weight the average anytime. We must do weighting. So weighting is required. And then some of the shares also were issued at free, aka bonus. And what happened to bonus shares? No weighting. So I'm going to make a very interesting revelation here. So anytime they give you a right issue, it possesses two contradictive issues. So we must break the number of shares into those that came in at full market price and those that came in for free or at free. So take notice of this. If you understand this, right issue will not be a problem. It will be things of the past. Things of the past. Now let's start right issue. So I'll be giving you steps. Please, here too, in other jurisdiction, I have to be very clear with you so that when you pick other books, other material, you will see formulas. But usually, target professional consult, yes, you are interested in formula, but just that sometimes in the examination room, you may end up mixing the formulas together. So we intend to impact principles. If we explain the principle behind that, oh, right issue, there was bonus and there was what? Full market price. And you know for sure that these two shares have a different basis. One we weight, one we don't weight. Then how do you combine them? So there will be what? A need for us to get the number of shares that came in at full and the bonus so that we can now do their respective treatment. So in that case, what's the principle? What's the way forward? What's the way forward? So the way forward is that there must be a steps, principles. So take notice. So if you read other materials or other books, you'll see formulas in there. But we go by principles so that you'll be very clear about this. All give us the same answer. Follow the one that you clearly understand. And you move on with the game. Now let's go straight. So I'm giving you steps. And I'll give you a trial question right now from the previous question we set, and then we'll build up. Then after right issue, I do dilution, any special we are done. No issue again. Please take notice that because of the interruption, the class may be extended maybe 10 to 20 minutes so I can be able to complete everything full. I don't intend to, so please try and then be with us. Steps in separating the number of shares. So the entire number of shares need to be separated. Steps in separating the shares. So steps in separating the shares. In separating the shares. Please, do you know why we have to separate the shares? They have two different contradictory and in one basket. So there's a need. Step one. Very simple. Very, very, very easy. Find the total proceeds. Total proceeds from the right issue. This one, it should be very straightforward. Total proceeds, the money they raise from the right issue. It's nothing by the number of shares times the right issue price times the right issue price. That's all. Nothing else, nothing more. Step two, calculate the almighty TEP. Calculate the TEP. When we say TEP, we mean theoretical X right price. Theoretical X right price. That's step two. When you say theoretical X right price, in theory, right after issuing of right issue, or right after issuing right issue shares, the market price is what you call the TEP. It's an average. It's also known as the weighted average number of shares right immediately, don't rest, immediately after the right issue. The share price is restored. So if you check it careful, every company right after the issue, a right issue, the share price will be automatically readjust, refocus, reroute, recentered on the TEP. And this is practical story that we are telling you here. So there's a formula, don't worry, or there's a way of calculating it. Then step three, you calculate the number of shares that come in at 4. Number of shares at full market price. Full market price. And then B, the number of shares at free or bonus. Then the storyline continues. So I'm done. Let me pick a question. That's all. If you know this, it's not a problem. Please let's just know this for us. If you know this one, I think you are okay. You are good to go. What left with solving more questions, different questions, so that it can build your system. It can make your immune system strong. Now, try out. I am just updating the old question. December 2019, the old question. I'm only updating the old question. So by the time I finish, the old question will be a highly examinable full question. That came one of the settings that we took our time to break it down in smaller components for you. Now, profit after tax, antipart, here was $50,000. I'm still repeating them. $50,000. And this is $70,000. And then they wrote here number of shares. $100,000. Hey, number of shares to in dollars. No, 100,000 shares. Here is dash for now. Note 1. Please, the note 1 we did are the same. I'm not changing anything. On where? 1st April, right? On 1st April 2020, 25,000 shares were issued at a full market price. Is enough. When they say full market price, is enough. Full market price is enough. Somewhere, note 2, on 10th, yes, it was 10th of July 2020, 1 for 4 bonus were issued. I want to shortcut it so that I can. Now let's come to the question of interest. Right issue. Let's give it a date. This one is July. September, yes. On 30th September 2020, the company issued 1 for 5. 1 for, let me make it 1 for 10. Let's make it 1 for 10. It can be 1 for 5, 1 for 10. So 1 for 10, right issue. 1 for 10, right issue. At a price of $2.5 per share, where the prevailing market price per share stood at $3 per share. Now, these are requirements. So this one is a full question. Now this can be a full examination question when I've added everything to it. So I'm now going to solve this fully together with everything we've done. So this is a full pass question. ACCA, ICA Ghana, SEMA, and then the rest. All of them will pick it up and do the needful. Required. These are the requirements to be like. First, calculate the earnings per share for 2019 and 2020 with a comparative earnings per share for 2019 included in 2020 financial statements. What a wow. So the one, once you see comparative earnings per share, that means there's a bonus element in the question. That's all. If you don't see comparative, there's a likelihood that there's no bonus element in the question. I'm done. Solution. 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 I have to be very fast here. First, I write 2019 here and 2020. Then write earnings per share. Of course, I have to code a formula. The more I code, the more I remember. Earnings per share is nothing but antiparts over ones. For 2019, antipart is still $50,000. Number of shares is still 100,000 shares. Hence, we are still getting $1 of 0.5. For 2020, the profit after tax is $70,000. We don't know the number of shares. Then we come and say comparative earnings per share. Into bracket, it's for 2019. Then you code a formula. It's equal to profit after tax all over the number of shares. You see, in exams, you must do this. It won't take you extra mile to do this. Even if you cannot calculate the adjustment, you can't do the adjustment. That does not mean that certain free marks you can't score it. In exams, many students want to behave as if they are the one that said the question. They want to answer the question fully, as if they have the whole day to answer. Not that. So in exams, number of shares plus bonus shares. In exams, if I can't do anything, I'll leave it like this. I submitted them. The examiner will give me something. At least I'll never work alone. Than to focus on this earnings per share and I'll not do anything. No. Than to focus on the right issue, then I'll not do anything. So let's go. So now we need a weighted average number of shares in 2020. This is the only thing that left. Then we are done with the question. You see how nice the story look like. Just left with this side. Go and look for it, come and put it in. We are done. Nothing else, nothing more. So let's go and look for X. As usual, once we are students, always we are finding X. Always X and Y is missing. We are finding them. Don't worry, let's go look for them again. As usual. Okay, so calculation. We are going to calculate weighted. So workings. Weighted average number of shares. Ones. First, my dates. Don't forget. This time around, my details. Again, my number of shares. Please make sure that your internet does not fail you this 11 file. Number of shares. The weight. Then the one who's Please, the very first one, you know them already, so we can easily produce them. Please. The very first one, you know them already. Then note 1 and 2, we've done it. So let me just produce them from the previous sections. We've solved note 1 and 2 already, so there's no need for us to waste time on it. So first, I'll say 1st of January 2020, balance brought down. The outstanding shares at the beginning, there were 100,000 shares. And we say the weight to be what? 12 over 12. So you get what? 100,000 shares. What the wow. Somewhere 1st of April 2020, they issued. So issue shares at full market price. They issued 25,000 shares. And the weight, we said that the weight should be 9. 9 over 12. Please, what did you get as the number of shares? What did you get? Was it 18,750 or so? 18,750 or so. $18,750. So is that true? I want to do it fast and do dilution, then move on. And then we now go to bonus. On 10th of July, the same year, they issued what we call bonus. Bonus issued. And we did calculation, we had 31,250. We say bonus, we don't wait. So you can say 12 over 12. 31,250. Good. So now we are going to read the right issue. That's all. So you are going to now tackle the right issue. Please join us for this. So now let's go. Follow the steps in separating. So these steps. This side is very important. We need a way of breaking it down. First step, find the total proceeds. So third examiner, steps in separating the shares. So steps. So separating the shares. Step 1, we must find the total proceeds. Total proceeds. So it's equal to the number of shares times the share price. How many shares were issued? They say they issue shares 1 for 10. 1 for 10 right issue. So 1 for 10. So that would be 1 over 10 times the number of shares at that time. Please, the number of shares at this time is what? Who can tell me? Add everything here. What will be the number of shares? So if you add everything here, you get 156, something or so. 156,250. Confirm for me if it is right. Yeah, so that's true. So over here, what happened is, so now strike the 1 over 10 on it. So third examiner, 1 over 10 times 156,250. That will be the number of shares that will come in. Good. So it will be 15,000. Now times the share price. How much they sell it for? So the share price, the price that is sold it was $2.5. So multiplied by 2.5, that's the proceeds. So times dollar of what? 2.5. What do you get? You're almost at the tail end of the story. So you get 39063. So you get dollar of $39063. Step 2, find a TEP. TEP is known as what? Theoretical X right price. This is how you calculate this. Maybe you can start by saying new. What's the new share? 1 share at dollar of 2.5. What will be the answer? 2.5. Go to the old 10 shares. 10 shares at what? What's the existing share price? The existing share price immediately before the right issue is $3. So $3. So that would be 30. 10 times 3 will give us 30. Put the two together. You get 11 and get 32.5. Now find the average of this. So therefore, TEP is equal to 32.5 divided by 11. What do you get? $32 divided by 11. So you get 2.95. Good, so that's correct. 2.95. So now we are done. Let's go to step 3. Step 3A. Number of shares at full market price. That one, divide the total proceed by the TEP. So it's equal to total proceeds divided by the TEP. In other language, step 1 divided by step 2. So what's the total proceeds? So it's equal to, what's the total proceed here? 39063. 3963 divided by TEP 2.95. So what do you get? Any answer for us? Oh, wow. We are getting 2 different answers. We need a third confirmation. 2 different answers. Third person to give us an answer to confirm. We need a third opinion. Okay, so 13,242. Good. So that will be 13,242. So that's number of shares. So these are the shares that came in at a full market price. So now we have to find B, number of shares at free or for free. That one is equal to the total number of shares minus the full market shares at full market price. Shares at what? Full market price. So how many shares came in? So this is the number of shares that came in. This side is the number of shares that came in. You had 15,625. That's the entire number of shares they received. I hope you get it. You even calculated it for me. So it's equal to 15,625. 625. Now minus those that came in. So the idea is that if we should go and buy the shares with a physical cash, you can only pay what? 13,242. So how many shares came in for free? And that's all with the storyline. Right after this scene, we are going to dilution. And we are done with earnings per share entirely. What a wow. Okay, so let's go to the storyline. So 2383 came in free. 2383. So now let's go and arrange this in our nice table. The third examiner on September 30th September 2020. Right issue. So just write here right issue. And do like this. The one at full market price. And then the bonus. Just demarcate them here. 13,242 full market price. Bonus is 2383. Okay. Now do the needful and weight them. From 31st of September up to the year end. How many months? How many months? From 31st of what? How many months? 3 months, yes, we finished 3 months. So that will be 3 out of 12. Do the calculation for us. Bonus will be 12 over 12. We don't weight bonus. So that is it. So here it will still be 2383. What about the weight? This is what you get if you multiply. 3 over 12, that's quarter. So it's the same as 13,242 divided by 4. 13,242 divided by 4. Three, 3,311. Please, this is the number of shares. You can't get point. If you get point, don't write it. If you get point, don't write it. You see, 3310.5. Yes, that's the correct answer. But you know, number of shares, it must be the whole number. Shares, either you are buying one full or you leave it. So let's put the weighted average number of shares together. This is a typical exam question. Wow. Typical exam question. Put all of them together from 100,000, all this down. And give me the answer. Then we move on with the story. Please, what do you get? Confirm. I need multiple answers. If you sum everything up, Sum up 100,000, all this. Please let's add all together for me. You can add here too. Yes, what do you get? 155,694. So 155,694. Confirm. Okay. So now we are done with the storyline. Let's go and put it in. So now X has been found. Always we are finding X. We'll be able to what? Locate the X. Y is missing. So it's 155. Is it 694? Yeah, 694. 694. Please do the computation for us and let's know our answer. Right after this, I'll discuss the dilution and then we are done with the story. Don't forget to join the main class. This one is just to test the course. How the main class look like. This is what you get. Oh, the answers are in. We've not tackled the diluted earnings per share yet. We've not even started that one. Right after this, 0.45 per share. Okay. So which year are they doing well? Who can tell me? Which year are they doing well? So for those who are doing advanced audit, which year are they doing well? Is it 2019 or 2020? The same story I pop up again. Tell the examiner that we cannot compare this to this. They are not of the same base, so we cannot compare. So we cannot compare. So we cannot tell which year they've done or no. Like we can't do it. Because there's a bonus in one, there's no bonus in one. And bonus always distort profit. So anytime something like that, we can't conclude. No way we can conclude. Then we can now come and calculate comparative information. This one is like a politician who have lost election and the journalists want to interview him. He said, I cannot conclude. I can't say anything for now. Let's leave the matter. He should tell you that he's in a hurry. But if he won, be the first person to request for the microphone. Yes. But I told you guys I win the election. But I've won. God have done it again. But if they lost the election, the first thing they say, fear delegates or fear voters. Yes. That's the same thing we are doing here. Now, let's calculate the comparative. Bring 2019's profit after tax. $50,000 divided by the number of shares that they had previously, 100,000. This one, let me do it at the other side. Please, this one, I want everybody to pay maximum attention to get this because there's something dicey here. Oh, there's no space. Where can I do it? There's no space. Should I squeeze? I don't also squeeze. Let me go and do it here. Comparative earnings per share. Please, I've got the formula already, so I'll not quote it again. First, 50,000, the number of shares, divided by the number of shares in our outstanding, plus all the bonuses, please, all bonuses. Don't bring some of the bonus and leave some. So how many bonuses we have? This is the first bonus, and this is the second bonus. So plus all the bonuses. The first one was 31,250. The second was 2,383. So for those who normally like the formula or for the bonus fraction, when the two are in the same question, you find it very difficult to answer unless you do diverse adjustments, and it usually creates issue. Okay, so what do you get as your final answer? And then we move on with the game. Final answer. Can someone confirm? Can we confirm? Okay. Another confirmation. So you are getting $0.37 per share. Now we can compare. So now we can compare. So you see, so now here should have been 0.37. So which are they doing well? Comparing 0.37 and 0.45, 2020, they are doing the best. Now we can compare. That's the meaning of comparative. I'm done. Let me talk about diluted earnings per share. If you have a question, kindly ask before I summarize diluted earnings per share. If you have a question, kindly ask before I summarize diluted earnings per share. If you do have a question, kindly ask before I summarize diluted earnings. That's the last section. Don't forget the 4 things. Don't forget the 4 things. Wow, then I will cite an example. Maybe for that one, I will not solve example because of our time. So I will explain how it is, and I will share a video on the various platform on how to solve diluted earnings per share question. That's all. So I will explain how that one works, the formula and everything, because we can't go beyond a certain time limit unless everyone agrees. All right, diluted earnings per share. Diluted earnings per share. Dilution of shares. What a wow. Diluted earnings per share. What is it? We call it DPS. What we've done so far is the basic earnings per share. But the dilution, let me go and explain dilution here. You see, I create some place with go diluted. Dilution. What is a dilution? Dilution is the situation where the shares has been watering in. So we define diluted earnings per share as what? Watering in of the shares. So take notice of that. Dilution is a reduction in earnings per share or increase in loss per share resulting from what? Convertible instruments that are converted. That's all. So take notice of that. So dilution is what? Reduction in earnings per share or loss per share, please. If the profit after tax is negative, you call it loss per share. not earnings per share again. Loss per share. So reduction in earnings per share or increase in loss per share. I have to make it clear. Or increase in loss per share as a result of convertible instruments being converted. Convertible instruments being converted. That's all. So you see, let me explain. Dilution simply means watering. For those who have been in secondary school or high school, you understand dilution very well. Sometimes if your breakfast or the tea or the is so saturated with sugar and milk, what do? You dilute it. If there's a one called soapies, yes. A lot of people dilute it. Yes. So what is dilution? We also have what we call anti-dilution. Dilution of shares normally takes place when there are certain instruments that are convertible. As I'm now talking to you, they are not ordinary shares, but they can be converted into ordinary shares. So you see, when the number of shares increases automatically, when number of shares increases automatically, earnings per share drop. So dilution is caused when the number of shares increases, and it will be as a result of what? We call it potential ordinary shares. Certain instruments can be converted into shares in the future date. So when they convert, it will do what? It will increase the number of shares, and hence it will reduce the earnings per share. So here, what causes dilution? Causes of dilution. There are three things that cause dilution. Causes of dilution. Number one is convertible debt. Convertible debt. Number two is convertible preferences. And then number three is what we call warrants or options. That's all. So these are three things that cause, please and please again, bonus issued or bonus shares does not cause any dilution. So anytime there's existence of these three things, after calculating the basic earnings per share, the diluted earnings per share will drop. This one will drop. That means there's a dilution. So when it drops like this, then there's what? Dilution. But when the diluted earnings per share increases, then we call it anti-dilution. So in that case, it cannot dilute the number of shares. Let me give you the formula, then I end here due to the time, and I will issue video on the computation and its formula. The formula for looking at the we normally call it potential ordinary shares. So take notice of whatever cost dilution is called potential ordinary share. The cost is called potential ordinary share. That's the name we call it. As I'm now talking to you, they are not shares, they are not ordinary shares, but they can be converted into shares. That is it. So as of now, they are not shares, but they can be converted into what? Into shares. That is why I say they are potential. So like when you say that we have potential mothers, have you seen? Potential fathers. The same way we also have potential shares. As of now, they are not. So take notice. Let me go the formula and leave you for now and then present the other story. So the formula, diluted earnings per share formula. It's always equal to the profit after tax, as usual, minus irredeemable preference shares. This time around plus savings. You see, let me pick one. Oh, let me do it here rather. That earnings per share is equal to profit after tax plus savings, net after tax, savings, interest saved. Interest or dividend saved. Here, net after tax, so net of tax, not net after tax, net of tax. You can just say 1 minus t, that's net of tax. All divided by the number of shares plus the new shares. I can explain the formula. You see, there will be a debt instrument. Debt, where you pay shares on, sorry, you pay interest on debt. Don't pay shares on debt. You pay interest. But this debt is a potential shares, ordinary shares, meaning that the debt can be one day, it can be converted into shares. So you pay interest. So as soon as you convert that debt into shares, what happens? Will you be paying the interest again? No. You are going to save the interest. And the savings, the interest is to the tune of what? Net of taxes. So you have to add all the savings that we are going to do in terms of tax, in terms of interest back. We can also save dividend. If it is preference shares, then we convert it to what? Ordinary shares. We save dividend. So when we save dividend, we have to add back to the profits. That's all. So that is the genesis of the top. If you check the formula I've given you. Then the downside number of shares, existing shares, you know it. And then the new shares. So when they convert the debt or the preference shares to ordinary shares, how many shares do you give to them? That's all. And then we are done. So basically, take notice. Then options or warrants. You see, sometimes some company can give their employees an option to purchase shares, option to buy shares. Good. So they can ask them to come and then take shares. So they have the right to buy shares in a future date. That is, if they leave with the company for 3 years. So share options. That share-based payments. This is equity settle. So if they live with the entity for the rest of or for a particular time, they are entitled to shares. So if they should exercise their right today, if they should exercise their right, the employees' right today by buying the shares, the number of shares will go up. So that's what you mean by dilution. So I'm down with the formula. I left the computation. I'll do that in our next meeting. But before that, you have to watch the calculation I did in dilution. Please, that video is very old. I think 2020 video. So yes, viewers' discretion is advised. It means that I think the video quality, the camera wasn't too bright and like today, but The sound is perfect. Everything is right there. No, it's, I think, okay, I'll send you an advanced video, don't worry. So I share that one with you. I'm done. Any question before I close the chapter of today's edition? Any question? Any question? So the video I'll share with you, please make sure that you watch. And then you go. Or you can just check the comment section. I will add the link to it. Any question for me before I close the chapter?